Let's talk about a really powerful idea in investing, maybe one of the most powerful, finding a business where the growth costs absolutely nothing. I mean, literally zero. It's a concept that kind of breaks traditional finance, and we're going to look at how some of the smartest investors on the planet use it.
And it all starts here. Warren Buffett nailed it decades ago. He's talking about a business that's basically a toll booth. It sits on a growing highway of commerce and just collects money without having to spend a ton to build more lanes. This is the absolute holy grail. It's capital-light compounding.
Okay, sounds great, right? But where do you actually find these things? I mean, really, how often do you find anything for free? We're not just looking for a good company here. We're on the hunt for a very specific, very rare kind of business architecture where the growth is just part of the package, not something you have to buy every single year.
So to find them, we've got to first understand the fundamental split in how companies grow. It really all boils down to two models. One is super common. It's how almost every business works. And the other is exceptionally rare.
This slide right here, this is the whole game. Most companies, even the great ones, are what we call additive. It's an A plus B model. They have their main business, the toll, A, and it makes money. But then they have to take a big slice of that money and spend it to get growth, B. It's an expense. The rare gems, though, they're multiplicative, A times B. Their toll is just naturally amplified by some huge wave of growth that they get to ride for free.
And I really want to hammer this point home. We are talking about world-class, fantastic companies. But even the absolute best of them usually have to constantly feed the beast. They have to reinvest a huge chunk of their profits to fuel tomorrow's expansion. Growth doesn't just show up. It has to be bought and paid for.
So what does this paid growth look like in the real world? Well, here's a perfect example. ASML, an incredible, domination monopolistic company, a titan. But look at this chart. A staggering 80% of its net income gets plowed right back into R&D for the next cycle. They have to keep spending billions to invent the future. That, my friends, is the definition of A plus B.
Okay, so if ASML is the definition of paid growth, of pushing a huge boulder up a hill, what does free growth look like? Let's meet the exceptions. The companies that don't push the boulder, they just get to surf a massive structural wave, and it costs them nothing.
And here they are. These are the big ones. For Visa and MasterCard, their toll is just that little fee they take on every single transaction. And the wave? They aren't spending a penny to convince people to use cards instead of cash. That's a global shift that's just happening. For S&P and Moody's, the world just needs more and more credit, and they get to rate it all. And MSCI, they are perfectly positioned to ride the massive, unstoppable wave of money moving from active stock pickers to passive index funds.
Now, let's take this a step further, into something even rarer. What happens when a business is so perfectly designed that you can't even tell the difference between the core business and its growth engine anymore? They just fuse together.
It's a concept called double naturality, and it's pretty amazing when you think about it. It means the company's moat, its competitive advantage, is natural, like a network effect that gets stronger all by itself. And its growth is also natural. It's a structural wave that just rolls in. The key here is that both of these incredible forces cost the business absolutely nothing to maintain or to grow.
So think of it this way. The growth, our B variable, just dissolves into the toll, the A variable. They become one and the same. For Visa, just being a payment network means it automatically grows as digital payments grow. The growth is inherent to the business itself. And the proof is right there in the numbers. Look at this. We saw ASML reinvesting 80% of its income. At free software, maybe 10%. But here's the real kicker. That 10% isn't for growth. That's just maintenance. That's for keeping the servers running and the lights on. They pay nothing for the powerful moat that protects them and nothing for the huge wave of growth that pushes them forward. Now, I know this might sound a bit theoretical, but it's not. There is clear, real-world proof that some of the most sophisticated investors on the planet see this exact pattern and are shifting billions of dollars because of it.
So let's get concrete and talk about Chris Hohn's TCI fund. This guy is one of the best investors alive. He's managing over $53 billion. But what's really wild is that it's concentrated in just 9 positions. Think about that. He's not diversifying. He is making massive, targeted bets on what he believes are the most perfect business models out there.
And what's so fascinating is watching what he buys and sells. Over a few quarters, he sold off his stakes in fantastic paid growth companies. We're talking Canadian Railways, GE Aerospace. And why?
He used the money to buy even more of the free growth businesses like Visa, S&P Global, and Moody's.
And this slide just lays out the logic perfectly. GE Aerospace is a phenomenal business, but its growth is what you might call mechanical. It has to reinvest a staggering $15 billion for every new innovation cycle. Visa, on the other hand, has natural growth. It reinvests $0 to grow with the shift to digital payments. For an investor like Han, the choice is obvious. Capital always flows up the gradient, from expensive growth to free growth.
But you have to be careful. How do you make sure a business is a true free surfer? Because not all moats are created equal. You need a way to tell the difference between a moat that's durable and self-reinforcing and one that's, well, fragile.
And this is a brilliant comparison. For years, FICO looked like a free surfer. It had a toll on credit scores. But its moat was built on what you could call regulatory sand. It existed because the government propped it up. The moment regulations changed and competitors came along, that sandy moat started to wash away. Compare that to Visa's moat, which is like a coral reef. It's a living ecosystem, a network effect. Every single new cardholder, every new merchant makes the entire reef stronger. It's self-reinforcing.
Okay, now let's get really esoteric. Let's look at an even rarer species in this little ecosystem. What happens when a business gets to ride not just one, but two interacting free waves at the exact same time?
This is the incredible reinforcing loop that MSCI sits in the middle of. So, you have wave 1, let's call it B1, the huge shift to passive investing. This creates massive demand for MSCI's index data. Then you have wave 2, B2, the explosion of AI. And AI is hungry for one thing: vast amounts of clean data. And here's the magic. As AI consumes MSCI's data, it actually makes passive investing even easier and more effective, which accelerates the first wave. It's a feedback loop. This isn't B1 plus B2. This is B1 times B2.
So you might be asking, why doesn't Chris Hohn just buy up all of MSCI? The answer is what's known as the prison of size. He's just too big. For him to buy a stake in a company like MSCI that would actually move the needle for his huge fund, his own buying would send the price soaring. He'd be competing against himself. And that creates this fascinating structural advantage for the smaller, individual investor. You can get into these positions quietly before the giants can.
And all of this leads to the final and maybe the most powerful insight of this whole framework. If these businesses are so obviously great, why do these opportunities continue to exist in the market?
The answer is pretty simple. The tools most people use to value businesses just aren't built for this. A typical spreadsheet, a discounted cash flow model, it forces you to apply a discount rate to future growth to account for risk. But what discount rate do you apply to a wave of growth that's structural, almost inevitable, and basically risk-free? The truth is, the model breaks. It just can't compute it properly.
And this is the thought I really want to leave you with. Because the market's standard models can't properly see or value this free, invisible growth, these businesses are often structurally and maybe even permanently mispriced. The true value, which is being driven by that unstoppable wave, is always just a little bit ahead of the price tag the market is willing to put on it. The market is always late, and the wave is always ahead.